Most traders believe high volume is a shield, a sign of a healthy, robust market where entry and exit are guaranteed. This belief is not just wrong, it is a fatal miscalculation. The truth is, the vast majority of liquidity visible on the order book is a carefully constructed illusion, a phantom designed to vanish in the span of a single microsecond. This is not a bug in the system. It is the system itself, operating with ruthless efficiency. Welcome to the lab. Today's case study dissects the architecture of the modern market, a landscape dominated not by human intuition, but by algorithmic predators. We will deconstruct the mechanics of phantom volume and expose how this digital mirage becomes the catalyst for catastrophic flash crashes, trapping unsuspecting traders in a market with no bids, no offers, and no escape. The story of phantom liquidity begins with a relentless pursuit of speed. In the world of high-frequency trading, or HFT, victory and defeat are measured in nanoseconds. An HFT firm's primary weapon is not a complex strategy, but proximity. Their servers are physically co-located within the same data centers as the stock exchange's matching engines. This proximity grants them a crucial advantage. They see market data and can react to it fractions of a second before anyone else. This speed allows for the deployment of specific, predatory order types unavailable to the retail trader. One of the most prolific is the immediate or cancel order, or IOC. An HFT algorithm can place and cancel millions of these orders across thousands of stocks every second. They are testing the waters, pinging the market to sniff out large, hidden institutional orders without ever intending to execute a trade themselves. The result is a torrent of market data that creates the illusion of immense depth and liquidity. The order book, the very foundation of a trader's decision-making process, becomes a lie. It shows a market teeming with willing buyers and sellers at every price level. A trader, seeing this deep liquidity, feels confident placing a large market order, assuming they will get a fair price with minimal slippage. They believe the volume is a safety net. But the real power of this algorithmic deception is hidden in how it behaves under pressure. To understand why this strategy traps so many, we must first examine the flaw in the retail trader's core logic. The human brain is conditioned to see patterns and assume consistency. It sees a thick wall of buy orders and assumes it represents genuine, committed purchasing interest. The algorithm, however, has no such cognitive biases. It has no commitment. Its sole purpose is to gather information and exploit inefficiencies. Those buy orders are not a wall, they are smoke. And when the first signs of real selling pressure appear, the smoke vanishes. Market data from 2022 reveals a staggering statistic. On any given trading day, for every 100 order messages sent to the major exchanges, as many as 99 of them are cancellation messages. The market is not a conversation of trades. It is an echo chamber of withdrawn intentions. This constant placing and canceling of orders serves another, more subtle purpose. It clogs the data feeds of slower participants, creating a data fog that obscures the true state of the market. While retail traders are processing stale, phantom data, HFT firms have already acted on the real information and moved on. But this constant probing and phantom liquidity is merely the backdrop. It sets the stage for a far more violent event. The true danger is realized when an unexpected catalyst hits the market. A surprise news event, a large institutional mistrade, a so-called fat finger error. This is the spark that ignites the dry tinder of the phantom order book. To see how this engineered fragility leads to a full-blown liquidity vacuum, we must analyze the anatomy of a flash crash. On that afternoon, the Dow Jones Industrial Average was stable. The market was liquid. The order books were deep. Traders saw nothing to indicate the impending abyss. At 2:42, a single, large automated sell order for E-mini S&P 500 futures contracts hit the market. It was a $17 billion order, programmed to be executed based on trading volume, a seemingly logical parameter. Under normal circumstances, such an order would be absorbed by the market's deep liquidity. But the liquidity on that day was not normal. It was a mirage. As the institutional selling algorithm began to aggressively sell, it targeted the visible bids on the order book. The HFT algorithms, which had placed many of those bids, detected the immense, indiscriminate selling pressure in a matter of microseconds. Their programming was simple and brutal. Do not absorb large, toxic order flow. Do not be the hero. Their response was instantaneous and universal. They canceled their bids, not just at the current price, but at every price level downwards. The wall of phantom buy orders that had provided a sense of security simply ceased to exist. In milliseconds, the market structure had been hollowed out from the inside. The institutional sell algorithm, however, did not stop. Its instructions were to sell a percentage of the volume, and it continued to hunt for bids. But there were none. What happened next defied all conventional market logic. The algorithm began chasing a descending staircase of phantom bids, pushing the price of futures contracts down 3, 5, then 10% in a matter of seconds. This collapse in the futures market triggered a cascade of automated selling across the entire stock market. Arbitrage bots, designed to keep futures and stock prices in line, saw the discrepancy and began dumping equities with blind fury to close the gap. This is the critical failure point, the moment the mirage becomes a vortex. The liquidity vacuum in one market created a contagion that spread with the speed of light. Blue-chip stocks, household names, began trading at prices that made no logical sense. $1, 10 cents. In some cases, a single penny. For minutes, some of the world's largest corporations were theoretically worthless. Retail traders with stop-loss orders saw them triggered at catastrophically low prices. They were selling into a void, their orders filled at levels they never imagined possible. They weren't just losing money. Their accounts were being vaporized. The entire event, from the initial sell order to the market's nadir, lasted less than 20 minutes. In that time, nearly $1 trillion in market value was erased. Regulators would later call it a freak event. But it was not an accident. It was the inevitable consequence of a market built on a foundation of fleeting, algorithmic liquidity. The flash crash was not a failure of the system. It was a demonstration of the system working exactly as it was designed. Greater than cancel all bids. But what the HFT algorithms did next is the part of the story most analysts overlook. Their withdrawal of liquidity was only step one of their protocol. To truly understand the predatory genius of their design, we must examine what they did when the market hit rock bottom, when panic was at its absolute peak. It was in that moment of maximum chaos that the second phase of their strategy was initiated. And it is this phase that reveals the true, cyclical nature of the liquidity mirage. As billions in stop-loss orders from panicked retail and institutional sellers flooded the market, desperate for any price to get out, the HFT algorithms detected a new inefficiency. The selling pressure was exhausted. The cascade was ending. The market, now trading at nonsensical valuations, was ripe for the taking. Their lightning-fast cancellation of bids was now flipped into an equally fast placement of new bids, positioned to absorb the final wave of panicked selling at deeply discounted prices. They had created the fire, and now they were returning to sift through the ashes for valuables. While slower participants were still reeling from the shock, the algorithms were accumulating shares of world-class companies for pennies on the dollar. They were not just avoiding the crash, they were profiting from the very panic they helped engineer. The same entities that removed the safety net were now positioned at the bottom of the cliff to catch the falling bodies. This two-stage process, liquidity withdrawal followed by liquidity provision, is not a defensive maneuver. It is an offensive weapon. The subsequent recovery was as violent as the crash itself. Prices snapped back, in some cases returning to their pre-crash levels within minutes. The HFT firms, having bought at the bottom, were now selling back into this recovery, realizing immense profits. The trillion-dollar mirage had evaporated and then reappeared, leaving a trail of decimated trading accounts in its wake. This event was a stark lesson, but it raises an even more disturbing question. If the architecture that caused the 2010 crash still exists, has anything fundamentally changed to prevent it from happening again? The evidence suggests it has not. In fact, the market has become faster, more fragmented, and more algorithmically driven than ever before. Many flash crashes in individual stocks, ETFs, and even entire sectors occur with unsettling regularity, often lasting only a few seconds before regulators can even react. They don't make headlines because they are contained, but they are symptoms of the same underlying disease, a structural reliance on phantom liquidity. The trader today faces a market that is, by design, perpetually on the brink of a liquidity crisis. This poses a critical challenge. If the volume and order book can no longer be trusted, how does a trader navigate this landscape? How can one differentiate between genuine market depth and an algorithmic mirage poised to vanish? The answer is not found in conventional technical indicators. Indicators like volume profile or VWAP are inherently flawed because they are built upon the same corrupted data. They are measuring the ghost, not the machine. To build a robust strategy, one must learn to look beneath the surface of price and volume. It requires a shift in perspective, from analyzing what is visible to deciphering what is intentionally being hidden. The key is to analyze the behavior of the order flow itself, looking for the digital fingerprints of algorithmic activity. One of the most powerful concepts for this is analyzing the limit order book's replenishment rate. Think of it this way. A healthy market breathes. Orders are filled, and new orders immediately take their place, like a rhythmic inhalation and exhalation. The replenishment rate is the measure of that breath. High-frequency algorithms, in their normal market-making mode, are the lungs of this system, ensuring the breathing is deep and regular. But just before they strike, they hold their breath. The replenishment rate collapses. Cancelled orders are no longer being replaced. This is the critical signal, the moment of profound quiet before the storm. It's the digital tell that the safety net is being pulled away, often seconds before the price even begins to fall. This is no longer about predicting where the market is going based on past prices. This is about understanding the market's structural integrity in the present moment. It's the difference between navigating with a map and navigating with a sonar that detects the ground beneath you about to give way. When you can see the liquidity providers actively refusing to post new bids below a certain level, you are no longer guessing. You are reading their intent. This leads us to the ultimate paradigm shift in trading. The goal is not to outsmart the algorithms. That is a fool's errand. The goal is to understand their programming, to recognize their two primary states, provide liquidity and exploit panic. By monitoring the order flow for signs of their behavioral shift, like a collapsing replenishment rate or the absorption of large orders without a flinch, you can begin to trade with the grain of the machine, not against it. You learn to spot the mirage before you die of thirst. You learn to recognize the V-shaped signature of their predatory cycle and position yourself for the recovery they themselves will engineer. They create the firestorm, but in its wake, they also create the most predictable and explosive price move of the day, the snapback rally. They are a force of nature in this market. But even a hurricane follows a predictable path. This is the new frontier. It requires throwing out the old rulebook that was written for a market that no longer exists. It requires you to stop looking at the shadows on the wall and start analyzing the machine that casts them. The code that runs the modern market is complex, but its prime directives are brutally simple. Learn to read that code, and you will cease to be the victim of the system and begin to harness its very logic. The market is a language. The question is, are you ready to become fluent, to move beyond the noise and start understanding the signals, to trade with clarity in a market designed for chaos? Subscribe to trade_logic_lab and join us in decoding the future of